This week, the foreign exchange market was a story of dramatic reversals. The mood among traders shifted quickly and decisively. What began as a week favoring the US dollar ended with a clear stampede toward traditional safe haven assets. Risk sentiment was the undisputed driver of all major market movements. We saw a clear pattern emerge. Currencies tied to safety and stability surged. Currencies linked to global growth and commodities initially faltered. The central theme was a flight to quality. Investors sought shelter from geopolitical and economic concerns. This was a week where fear spoke louder than fundamentals. The primary catalyst for this shift was a noticeable change in the global risk landscape. The US dollar started the week on strong footing. Many traders initially bought the currency. They saw it as a safe place amid early signs of global uncertainty. This initial strength, however, did not last. By the end of the week, the dollar had lost significant ground against each other. It started those major, big some peers. A series of events combined to change the market's perception of the greenback. The narrative shifted from one of US strength to one of growing domestic vulnerability. This reversal was swift and showed how quickly market sentiment can pivot. The dollar's early gains evaporated as new information came to light. Several Federal Reserve officials made comments that spooked investors. Some influential voices on the policy setting committee began to talk more openly about cutting interest rates. They pointed to signs of a cooling economy as a reason for potential easing. Others warned that the labor market, a traditional pillar of US strength, could weaken in the coming months. This dovish talk directly undermined the dollar. A currency's appeal is often tied to its interest rate. The prospect of lower rates makes holding that currency less attractive to foreign investors seeking higher returns. The euro's performance this week was a story of balance. The single currency remained relatively steady against a basket of its peers. It did not experience the dramatic swing seen in the US dollar or the Swiss franc. This stability was the result of two opposing forces. On one hand, positive news on inflation provided a solid floor of support for the currency. On the other hand, persistent signs of weak economic growth and sluggish sentiment acted as a ceiling, preventing any significant rally. The euro was effectively caught in a tug-of-war between these conflicting narratives, leading to a week of sideways trading. Inflation data from across the eurozone came in largely as expected. This was a source of relief for markets. It eased fears that rapidly rising prices would force the European Central Bank to a more aggressive policy stance. Stable inflation suggests that the current monetary policy is appropriate. It reduces uncertainty for investors. Section 4, the franc's fortress, CHF serves as a sanctuary from market storms. The Swiss franc was the undisputed champion of the currency markets this week. It emerged as the strongest performing major currency by a wide margin. Its journey from a position of relative weakness at the start of the week to one of overwhelming strength was remarkable. This surge was almost entirely driven by a massive wave of risk-off flows. As anxiety swept through global markets, investors abandoned riskier assets and scrambled for the perceived safety of the franc. The currency acted as a financial fortress, drawing in capital from all corners of the globe as traders sought to shield themselves from growing uncertainty. The primary trigger for this stampede into the franc was the sudden escalation in U.S. China trade tensions. The news that China was imposing new port fees on U.S. vessels sent a shockwave through the markets. This development torpedoed investor sentiment. It sparked fears of a deepening conflict between the world's two largest economies. In such an environment, the Swiss franc's traditional role as a safe haven came to the forefront. Investors have long trusted Switzerland's political neutrality, economic stability, and strong financial system. Section 5. The loonies roller coaster, oil woes data dips, and a late week rally. The Canadian dollar had a particularly volatile week. It began the period on a very weak note. For most of the week, it was the worst performing currency among the major economies. Falling oil prices, poor domestic economic data weighed heavily on the loonie. The initial move was sharp and painful for anyone holding the Canadian currency. Dramatic turnaround, significant recovery late in the week. This rebound was fueled by a shift in sentiment and some positive local news, but it was not enough to erase all the earlier losses. The loonies' troubles started with the price of oil. Section 6, Asia Pacific cross currents and concluding thoughts. In the Asia Pacific region, the market story was mixed, reflecting a complex and varied economic landscape. China's economic data presented a divided picture. On one hand, the country's trade numbers showed surprising strength, positive sign for global commerce. However, other indicators were less convincing. Data on new loans and aggregate financing suggesting that credit growth was not yet on a smooth and stable path. In policy news, officials in Shenzhen announced a new semiconductor fund to bolster the domestic tech industry. Beijing clarified that new rare earth regulations were not a blanket export ban and signaled a willingness for more dialogue with the United States. Elsewhere in the region, the news was decidedly weaker. Australia delivered a disappointing jobs report, which pointed to a cooling labour market. This increased the chances that the Reserve Bank of Australia might have to cut interest rates again. The RBA itself noted in its recent minutes that financial conditions had already eased following its recent cuts. In neighboring New Zealand, the story was similar. Business activity continued to show an ongoing contraction, and weak retail sales data highlighted cautious consumer behavior. And these trends kept the Australian dollar under pressure for much of the week, and the New Zealand dollar under pressure. Japan faced a different kind of challenge. Political risk. A key partner in the ruling coalition split from the government, injecting a dose of political uncertainty into the market. The political turmoil came at a time when industrial activity was already falling. Despite these domestic issues, the Japanese yen still benefited from the broader flight to safety. As a traditional safe haven currency, it attracted buyers who were fleeing risk elsewhere in the world, demonstrating that in times of stress, global sentiment often trumps local politics. Looking back, risk sentiment was the undeniable kingmaker this week. When fear was on the rise, safe haven currencies like the Swiss franc and Japanese yen reigned supreme. When that fear subsided, even briefly, battered commodity currencies like the Canadian dollar found some relief. The U.S. dollar, caught between dovish Fed talk and its own domestic issues, failed to perform its usual safe haven role. Takeaway 1, risk aversion was the primary driver, pushing capital from growth-linked currencies like the Canadian dollar and the Australian dollar to traditional safe havens, the Swiss franc and the Japanese yen. Takeaway 2, the US dollar's path was dictated by domestic factors as soft data and dovish Fed commentary overshadowed its safe haven appeal. Looking ahead, traders should keep a close eye on signals from the Federal Reserve